So let us take this opportunity by welcoming you to our today's session. We are going to be doing a recap of what on how the questions of business income are normally set. So in this case, because already we have done an introductory part of the taxation of the business income, I just wanted to do a question of November 2017, question 5B, to be able to remind ourselves on how we are supposed to be computing the taxation of business income before we check on the taxation of the investment income together with the taxation of the partnership. So I'm just requesting one of you to be able to read our question straight away.
I'll read. Dow Limited provided the following income statement for the year ended 31st December 2016. Turnover 27,400,000, less cost of sales, less cost of goods sold 11,000, gross profit 16,400. Add other income, capital gain on sale of assets for 68. Sorry, I'm having a lot of background noise.
Go on.
Capital gain on sale of assets for 68. Insurance recovery on motor vehicle for 50. Dividends from subsidiary company 942. Foreign exchange gain 124. Interest on fixed deposit 300. Less expenditure. General expenses 4840. Impairment loss 390. Bad debts 485. Advertising 248. Donation to disaster fund 150. Property tax 136. Branch closure costs 178. Legal expenses 1240. Staff costs 3496. Net profit 11,163. Additional information. The cost of goods sold included opening stock valued at 2.2 million, while closing stock was stated at 2.8 million. The opening stock was overstated by 10% and closing stock was undercut by 30%. Legal expenses comprised acquisition of bank loan 90, settling customers' disputes 42, preparation of memoranda of association to 60, liquidation costs for 68, patent rights 340, notices to defaulting debtors 40. General expenses comprised purchase of processing machinery 800, purchase of factory building 1280, provision for corporation tax 394, purchase of furniture 360, directors allowances 480, VAT appeal 120, credit notes received 135, delivery van 720, debenture interest 551. Bad debts analysis. Please move down. Bad debts 178, balance carried down, specific provision 560, general provision 167. Balance brought down, specific provision to 40, general provision 180. Profit and loss account 485. Staff costs include staff development cost 96,000, staff welfare expenses 200,000, pension contribution 1.48 million, and personal computer 360,000. Advertising include neon sign 129,000, depreciation of delivery van 24,000, carriage outwards 9,000, and hire of billboards 86,000. Required a statement of adjusted taxable profit or loss for the year ended 31st December 2016, and corporation tax payable, if any, by Dow Limited.
So I remember, thank you. I remember I said when you come across this kind of a question, the most important thing is you start with the additional information. You carry out the analysis first before you go to the to check on income statement. I remember that because it's a question of adjusted taxable profit or losses, we are going to be looking on what are some of the transactions which were made but they are not as per the act. So in this case, when I look on the question, we have to be asking ourselves, what happens? Because I remember in our first class, I was able to give you a good insight about what happens to the opening stock in terms of the overstatement and understatement of the gross profit together with the closing stock. So in this case, I remember I say the opening stock was overcasted by 10% and the closing stock was undercasted by 30%. I remember I said if you are able to overcast the opening stock and the purchases, then it means you are going to be understating. If you overstate the opening stock and the purchases, you are going to be understating the gross profit. So it means that to correct that problem, I have to be adding back the overstatement of the opening stock and purchases. I remember also I talked about the aspect where when you understate the closing stock and also you understand to your sales, we say they have a direct relationship with the profit. It means also the gross profit is going to be understated and so on. So in this case, those are the things that I'm supposed to be putting into consideration. Number two, I remember I said that there are some of the legal expenses which I was able to give in our notes. And when I look on the question, we have been told there is an acquisition of the bank loan. There is a settling of the customer dispute. When you look on the acquisition of the bank loan, we say it under the act. We talked about looking on the aspect of the interest on loan and the only recognized expense, but the acquisition of the bank loan should be part of the capital. That is a capital cost, so it should not be affecting the income statement of the organization. Settling the customer dispute, that is an allowable expense. I remember I have already given you an example of a credit controller. When they have some issues with the customers, for instance, they are unable to pay, he has to be writing demand letters, which are supposed to be financed by the organizations to acquire a lawyer who is going to be writing those demand letters. We have the preparation of memorandum of association. We talked about MOA as part of the capital cost, which is not supposed to be affecting the income statement now. We have the liquidation cost, patent rights. We also talking about the costs which are supposed to be incurred before the business starts. We have the notice for notices to defaulting debtors. We also know that is an allowable expense, because when we send a notice, it is basically part and parcel of what you're supposed to be doing in terms of the steps of raising some legal matters. You have to be sending, when to prove your case in the court of law, I think you're supposed to be sending out some notices to the defaulting debtors on giving them a timeline. If you are not going to be paying within a given stipulation of time, I'm going to be taking a legal action and so on. Some threats which basically they may or may not pay. Now, number three, we are talking about the general expense, which basically comprised of, we said, under the taxation, we don't recognize the purchase of an asset. We say any asset that we have already purchased is not recognized. And what we normally recognize as an expense in taxation is about the capital allowances of these assets. So when I look on note number 3, we have been told there is a purchase of the processing machinery, which is a disallowable. Purchase of the factory building, disallowable. Provision, we say all the provisions are disallowable expense, except one, where we talked about the specific provision for the bad doubtful debts. We talk about the purchase of furniture, which is a disallowable. Direct allowances, which are allowable expenses. VAT appeal, we know very well that the VAT appeal might be due to negligence in terms of how we are supposed to be conducting our issues. I have already talked about how we are VAT based on how we are supposed to be conducting our VAT matters. We have the credit notes received. I said we can be able to make an assumption. This credit note received is already concerning the purchase of these machineries. I can be able to see there. We also having some issues like delivery van. We talked about being a disallowable expense, but the debenture interest is an allowable expense. Now, I talked about the bad debts analysis, and I said under the grouping of the bad debts, we talked about having 2 categories. We said we have the specific, and then we have the specific, and then we have the general. Generals are disallowable and also non-taxable if there is an increase or decrease. but the specific, they are basically allowable and taxable incomes if there is an increase or decrease. When you look on number 5, we have been told the staff costs, which are basically including the staff development cost of 96,000. We know very well that organization normally provides staff training, which basically is going to be assisting the employees to gain some knowledge on the fields of study. We have staff welfare expenses regarding to what the employees are going to be about the welfare employees. That is an allowable expense. We have the pension contribution. You know very well the pension contribution might be like the one that already the employer normally contributes on the behalf of the employees, the NSF contributions. Now, we also have some aspects where we are discussing about the personal computers, which are disallowable expenses. Now, let us go to number 6. We are talking about advertising, which basically includes neon sign qualified for capital allowances. Depreciation is not recognized in under the taxation. We're also talking about the carriage outward. We know that is allowable expense together with the hire of the billboards. You have to be hiring the billboards. That is part of the marketing strategy organization basically use. So already those are things that I'm supposed to be understanding before I start my question. So I just want to go straight and start my question and look on what I was supposed to do. So let us go there now, right? So in this case, I'm going just to be starting with the topic of the question. We are talking about the Dower Limited. Dower Limited. And then we are looking the year in which we are going to be preparing the adjustable taxable profit. We are being told it is 2016, right? Taxable income computation. Taxable income computation. So in this case, we have 2 columns here of Kenya shillings, right? Now I know that Rose is able to understand this. Then we are going to be limiting our shillings into thousands. We work very quickly. So in this case, we start with the reported profit. Reported profits. And when you look on the reported profit, examiner has already given you around 7,521. I just put it here to do my adjustments. We said, let us add back disallowable expenses. Disallowable expenses. Let us add it back. All the disallowable expenses. These are the expenses which are not recognized by the Tax Act. Now, as I have said, we basically start with the additional information. Additional information basically assist you to be able to sort out your problem very quickly. So let me start with this additional information here. As I have already told you. So the additional information number 1, there is overstatement or overcast of the opening stock. So in this case, I'm going to be adding it back. I say, let me add overstated opening stock. Right? The overstated opening stock is going to be reducing our profits. So we add the proportion because it means the already opening stock provided there. It is not 100%, it's 110% because it was overstated by 10%. So in this case, how am I going to be how am I going to be calculating my overstated? I say, I just want to look on the 10% which was overstated. So in this case, I say, if 2200 is equivalent to 110%, what about 10? So it will be 2200 times 10 over 110. So that I can be able to get the proportion which was overstated of 10%. So if you take your calculator, I just want to take 22,000 divided by 110. Divided by 110, getting 200 shillings. 200 here. That is only the proportion which was overstated. Now, the other thing that I was able to see, there was understatement of understated. We are talking about closing stock. If there was understated, remember, we are being told it was 30% understatement. So in this case, it means the closing stock provided in the question is 70%, right? What about the 30% which was understated? So it will be 30 over 70. Then you multiply by 2,800. Because already you know they have given you 70%, which is 2,800. Then they undercasted by 30. We want that 30% which was undercasted, you add it back to correct the error which they made there. So in this case, we are just saying 30 divided by 70. We multiply by 2,800. We are getting 1,200 here. And I think that one is very clear. Then from there, we go to the additional information 2. We say the acquisition of bank loan is a disallowable expense. I just write it here. Acquisition of bank loan, right? We are being given how much? The acquisition of the bank loan, they have given me 90. The other one we are talking about, settling customer disputes, we say it is allowable expense, but we have preparation of MOA, which is a disallowable expense, amounting to 260, right? 260. We have liquidation costs, right? Liquidation costs. Liquidation costs. Our liquidation cost as per the question, we are being given 468. Then we have patent rights, disallowable expense. Patent rights, how much are we given there? The patent rights, we are given 340. 340. Then we have notices to defaulting debtors. We said it is an allowable expense. Let us go to the next one. The next one we are being given, right? The next one we are being given, the purchase of processing machinery. Purchasing of processing machinery. Processing machinery, we are being given how much? 800. Disallowable expense. Then the other one we are being given, the purchase of factory building. Factory building. We are already given how much? The factory building, we are being given 1280. 1280. Then we are being also told, we said all the provisions are disallowable, except only one, provisions of corporation tax. Corporation tax, we are being given how much? 394. Right? 394. We have purchase of furniture. Purchase of furniture, I'm being given 360. That is the purchase of furniture. We have direct allowances, I said, is allowable. We have VAT appeal. VAT appeal, we are talking about 120. Nimeona Namuli akisema na unsuccessful or successful. No, that does not apply here. Then we have credit not received. Credit not received. Hapa nita make assumption relates to the fixed assets. Na nieke the value, the fixed asset. So the credit not received, 135. Then we have the other one, delivery van. Nieke hapa, we have Kenya shillings, somewhere here. Thousands. So here we are talking about delivery van. Our delivery van amounts to 720. Total note number 4. Note number 4, we are discussing about an increase and decrease of the bad debts. And in our question there, tumeona kuna non-taxable income when we are analyzing our general provision. Hiyo tutafanya baadaye. Total number 5. Number 5, we say the only disallowable expense there is the personal computers. So our personal computers amounts to how much? We are talking about 360. 360. So the personal computers are disallowable expenses. Now, when we go to note number 6, we say that advertising include neon sign. Neon sign. When I look on the neon sign, which are disallowable expense amounts to 129. We have depreciation. Depreciation. Our depreciation amounts to 24. Do we have anything else? We have something called the others allowable expense. Sasa mimi, wacha nikimbie straight away to the additional, to the income statement now. So we have general expenses, allowable expense, and we have already analyzed it. We have impairment losses, which are disallowable expense. Impairment loss, disallowable expense amounts to 390, right? The other one we have bad debts, and we shall be able to analyze them. We have donations. Donations, disallowable. Disaster fund, amounting to 150. We have property taxes. Our property tax amounts to 136. Branch closure. Branch closure cost amounts to, when I look at it, amounts to 178. Right. That is the branch closure costs. Then we have, do we have anything else? The other one, the legal expense, okay. Staff cost, okay. So we can go to the deductions. We say less allowable expenses with stock non-taxable income. Non-taxable incomes. We are going to be starting with decrease in general bad debts. In our case, we are talking about, at the beginning it was 180, then at the closing was 167. So 180 minus 167 amounts to 13. Then also we have some income there which they don't relate to the business. We have capital gain. Capital gain. The capital gain relating to the sale of assets, 468. We also have insurance recovery of motor vehicle. Recovery. This is non-taxable income. Amounts to 450. 450 there. We are also discussing about, what else are we discussing about? Dividends from subsidiary companies. Subsidiary amounts to, dividends from subsidiary amounts to 962. 942, I think, something like that. Then we have foreign exchange gain. Forex gain. The forex gain, we said it was successful. No, it was realized. Sorry for that. Meaning realized, naeka dash there. Then also we have interest on fixed deposits, right? Interest on fixed deposits. Interest on fixed deposits amounts to, interest on fixed deposit amounts to 300. 300 there. Then now, give the capital allowances to the expenses that you think they qualify. We start with the processing machinery. Processing machinery. The rate you know very well is 50%. 50% of, I've started with the purchasing of processing machinery. I can see it's amounted to 800. Now this is 400. The next one we have factory building. %50 of our factory building is 1280. So 0.5 times 1280 amount to 640. Yeah. The next one we are discussing about furniture. 10% of 360, which is at 6, right? We have credit note, we have talked about delivery van. Delivery van, 710, 25% of 720, right? 0.25 times 720, amounting to 180. Then also we have personal comms. Personal computers. Our personal computers, I can see, is 25%. 25% of 360. Getting 90, right? Then we have other expenses like yes.
Excuse me. Why
Yes,
are we
yes.
giving personal computers? Why are we giving an allowance yet it doesn't belong to the company?
The personal computers.
Yes.
Why?
The personal computers do not belong to Dawa Limited. So if we give it a capital allowance, it means it's part of the fixed asset of Dawa Limited, which is not.
But the capital which was able, it is part of the staff cost.
I think we should disallow it and scrap it off the books because it doesn't belong to Dawa. I just think that way.
It's okay, no problem. Let me get rid of it. That argument is also okay. Let me not add much. Yeah. Next one is we have, after the personal computers, we have the neon sign. The neon sign is 10% of 129 coming to 12.9. We don't have any other, by the way. After these ones, we don't have any other. So after that, just do your summations here. Right? It will be 12.9 plus 180 plus 36 plus 640 plus 400, right? Plus 300 plus 942, right? Plus 450 plus 468 plus 13. Minapata 3441, 3449. Let me take it out. That's 3441.9. That is what we are supposed to be subtracting. The other one is the additions, 200 plus 1200 plus 90 plus 260 plus 468 plus 340 plus 800 plus 1280 plus 394 plus 360 plus 120 plus 135 plus 720 plus 360 plus 129 plus 24 plus 390 plus 150 plus 136 plus 178. Mimi napata 7734. Yo utapata ngapi? So I just want to add 7521. Then I subtract 3441.9. Getting 11,000 will be the adjusted. Let me write it here. Adjusted business income will be amounting to 11,813.1. There is something called other incomes now, which this is how they are supposed to be grouping it. There is an income from the fixed deposit account. It is the other income of the business. You put it here. Interest on fixed deposits. What they did in your income statement, wali are direct, like a taxable income relating to the operations or transactions of the business, should be part of the other income of the 300 now here. Inapaswa kuwa kando peke yake. No any other business we are supposed to be doing there. Here we are discussing about adjusted taxable income. Adjusted taxable income amounting to 12,000 113.1. 113.1. Mimi nishafanya hiyo, najua vizuri sana. The interest on fixed deposits, which is basically what we are tackling next. Clarification in terms of what normally happens if it relates to the business. What happens if it is relating to individuals. So part 2, we are told to calculate our tax liability. Right, tax liabilities. So in this case, I'm just going to be taking 30% of 12,113.1 times 0.3. We are getting 3633.93. Then we less. There is something we are supposed to be lessing here, talking about the withholding tax relief. What is this withholding tax relief coming from? It is coming from the fixed deposit account. So we are talking about non-qualifying interest. In this case, the withholding tax at the rate of 15% is not final. What does that mean? It means that the gross amount is normally added to other incomes, what we have done there. Then the withholding relief is going to be granted. It means the withholding relief normally reduces the burden of taxation. So when we look on it, mimi naonanga organization mingi zinapenda withhold. When we are withholding taxes, it means ni kama nashtaki tu my business partner to the KRA, to the authorities that I have done business with so and so. So already there is a proportion of your money that you already shatumwa KRA. So already if my tax liability is at 633, then the withholding is going to be reducing because already kuna pesa yangu KRA already washapewa. So in this case, we are just discussing about, we take 15% of our gross amount, which is 300. We are talking about the interest on fixed deposits. So in this case, 0.15 times 300 comes to 45. Then we come to do our tax payable. Our tax payable should be how much? That's 633.93 minus my answer, coming to 3588.93. 3588.93. Any question now? Rose, any question?
No question.
Is it okay?
Yes, it's okay.
Very good. Very good. Very good. Now, I just want us to focus on our next thing that we are supposed to be doing. And that next thing should be the taxation of the investment income. Taxation of the investment income. Ndio uweze kuelewa, how am I supposed to be dealing with the interest on fixed dividends and so on and so forth. So let us shift our gears there. Let us go there. So when you look on the taxation of investment income, we are saying investment income arises in form of dividends and interest. And this is the aspect in which you find majority of the investors are working on to analyze to analyze the audited financial statements so they can be able to see how the organizations are making profits. Hakuna mtu anapenda to invest on those organizations which are making losses. In this case, we just take a risk and purchase some shares from that organization, maybe the preference shares, sorry. And in this case, once I buy the shares, I'm going to be looking on the aspect of getting dividends and interest respectively. So in this case, that is where we are saying these investments are normally taxed in the year they are earned. So let us first break down the dividends income, and we are saying the dividends are received from the investment made in shares of the company for tax purposes. They are normally grouped into three. We normally have the exempt dividends, we have the qualifying dividends, we have non-qualifying. When I look on the exempt, it means when you talk about the exempt, it means there is no any form of taxation which is subjected to such dividends at all. So those dividends are not going to be subjected to any taxation, and they normally include dividend received from investment made outside Kenya, Dividend received by the company from another company where it controls more than 12.5% of the voting rights. It means you have to be looking on the dividends, and you can see there is an area where we were dealing with subsidiary companies, where you find that the company is controlling more than 50%. So in this case, already we know those are exempt dividends. They are not subjected for further taxation. Now we have the dividend received by an insurance company from investments of its life fund. We have the doomed dividends, and we are saying that is any form of distribution where in cash and cash terms made to ordinary shareholders upon voluntary winding up of the company. Those are the doomed dividends, and they are not subjected to any taxation. Number two, we are talking about the qualifying dividends, and these are the terms that I'm going to be using moving on. So we are saying they attract a withholding tax at the rate of 5%, which is final. That it means that they are not subjected to any further taxations. And in this case, they normally include dividend received from financial institution and body corporates. And also we have the dividend received from SACCOs. When I see that these organizations giving dividends to individuals, kama saizi, we are waiting some dividend distribution from most of the organization. Let me talk about the Safaricom SACCO, Mwasibu SACCO, Azina. They are not now going to be distributing their dividends to its members by the month of March moving forward. So in this case, when you look on the dividends which are distributed to individuals, mimi na wewe, those dividends are qualifying dividends. Why? They are not subjected for further taxation. Hakuna mahali utaenda upate ati KRA inakuita ikwambie you received some dividends from a given organization. No. Those dividends which are subjected or which are already declared to individuals are final. They don't attract any further taxation. Let us go to number 3, where we are discussing about unqualifying dividends. We are saying a withholding tax of 15% is not final. That is, the gross amount is added to other income, like what we have done with the interest on the fixed deposits. They are normally added to other incomes, taxed accordingly, after which a withholding relief is normally granted. And we are saying these are the dividends received from a cooperative society other than a SACCO. In this case, when you're discussing about the dividends and the interest which are unqualified, in simple terms, look on those dividends which are going to be received by the institutions, right? We are discussing about the limited liability companies. Those dividends are not going to be final. So they are normally called non-withholding tax. We have to be recognizing them when you are computing the taxable income. In the preparation of the taxable income, like what you could see I have done when I was doing my adjustments, I had the gross amount, then I'm going to be granting the withholding tax relief. Now, let us also analyze the interest under the same case, and we are saying it is the income earned for using someone's money. And you know very well that this basically applies whereby we are going to be giving out grants, for instance, to the government by purchasing bonds. And you know that when I purchase a bond, I'm going to be getting some interest from there. And those are the things that I know mostly we have been analyzing under the valuation concepts for the bonds and so on. Now, they normally also grouped into exempt, qualifying, and qualifying. So when you look on the exempt interest, we are saying not subjected to any tax. They normally include interest received from abroad, interest received from investment in a registered home ownership plan. We talked about OSIP, home ownership saving plan. We are not supposed to be having two plans there. Then we have number 3, where we are discussing about the interest received from investment in registered pension schemes. Number 2, we are discussing about qualifying interest, and we are saying a withholding tax is 15% is final. It normally includes the interest received by individuals only from financial institutions within Kenya. Let us look on non-qualifying interests. We are saying a withholding tax of 15% is not final. It is subjected for further taxation. The gross amount is added to other incomes, taxed accordingly, and those are the things that already I have done there. So we are saying tax according, of which you are going to be granting some tax relief later on. They normally include the interest received by body corporates from financial institutions within Kenya. But what is a body corporate? And we are saying it is a corporate entity that has a legal existence. And we know that we are discussing about the private companies, public companies, small companies, one-person company, limited liability partnership, and also we discuss about the foreign countries. That is what we discuss about the body corporates. That is done and dusted. There is that knowledge we are just going to be using it when we are going to be analyzing the interest and dividends. Now, let us focus my attention to where examine also normally targets a lot. Taxation of a partnership. And very well I know that if Mwalimu and his students are going to be partners later on, when we are doing our business, we are saying that the partnership that we are going to be doing, or the income that we are going to be generating from this partnership, is not going to be taxed. It is, we are saying, it is the respective partners who pay taxes on partnership income together with other incomes based on their profit and loss sharing ratio. So already you know very well, if we have already, or we are doing our businesses and we have a partnership business, then it means that the partnership business that we are going to be having is not going to be followed by the KRA, but the Kenya Revenue Authority is going to be following individuals who benefited from those income generated there. So the computation of adjusted partnership income is similar to any other business, except that no transaction between the partnership and partners is basically allowed. Number one, when we look on the things which are relating to the partners are normally adjusted under the partners allocation schedule, and that is what we are going to be analyzing down there. Number one, we discuss about the salaries to partners are disallowable expenses. Interest on partners' capital are disallowable. Number three, we are discussing about commission bonus paid to partners is disallowable expense. The drawing of goods by partners is disallowable. We simply adjust for unrealized profit by adding back the drawings at cost and deduct at the selling price. That is, drawing affects both the cost of sales and sales. And we know very well whereby the drawings which are basically done under the preparations of the financial statements, we normally adjust it somewhere under the cost of sales. Now, when you look on number 5, we are talking about the interest on drawings is an untaxable income. Number 6, we are discussing about other incomes are not adjusted for the business income, but in the allocation schedule. Now, the above items are, however, included in the allocation distribution table. And in this case, when you look on the allocation schedules, for instance, if we have two partners, partner A and partner B, we are going to be taking their salaries and salaries to them. We are going to be calculating the total there. The interest on partners put in place, bonus put there, commission put in place for each partner. And then we are going to be deducting our interest on drawings. And then there is a share of profit and loss from the business that we have already conducted during the period. So we are going to be taking that adjusted business income, do our maths, and then we are going to be able to know each partner what is going to be benefiting from the partnership based on the profit and sharing ratios provided. So to be able to understand much about this, I just wanted to do an illustration, and we are going to be starting with we are going to be doing very quick things, nothing different from what I have taught you. So let me start with a question of April 2022, question 2B. April 2022, question 2B. Let me start from there. April 2022. Let me check what they brought there. So April 2022, our paper now is CA34. That is the code of your paper. So we are discussing about question number 2B. Someone to read, please. Someone to read 2B.
Amoa and Beba have carried on business for the last several years under the trade name AB Partnership. They share profits and losses equally, with capital contributed earning interest at the rate of 10% per annum. The following details relate to AB Partnership's transaction for the year ended 31st December 2021. 1. Amua and Beba capital accounts reflect credit balances of 1.2 million shillings for each. 2. On 1st April 2021, they introduced a new partner, Chanda, who was to contribute 1.2 million shillings as his share of capital. They agreed on this day to share profits and losses in the ratio of capital contributed proportional to the period of the year it was invested, and that this sharing ratio be backdated to the start of the year 2021. 3. The costs incurred during the year were as follows. We have the salaries and wages for staff as 1,083,000, salaries and wages for staff 389,400, electricity and telephone 294,400, repairs and maintenance 420,000, depreciation and impairments 471,000, general insurance 150,360, debenture interest paid by ABC Limited 1,150,360. We have directors' fees including 507,720, partner salaries amounting to 1,015,440. We have legal expenses, 510,240, medical contributions for partners and directors, 651,840. We have drawings by Amua, 99,000. Beba had drawings of 101,400. Chanda had drawings of 65,400. Rent and rates at 315,960. Kindly scroll down.
Okay.
We have rent and rates at 315,960, motor vehicle running expenses 500,760, printing and stationery 32,520. Additional information number 4, the following assets were purchased during the year: furniture and fittings at 192,000 and a pickup for shillings 2.16 million. We have additional information number 5. During the months of the partnership, the total salaries to partners were 507,720 shillings. The salaries were to be apportioned according to the period each partner served in the partnership business. 6. The cost of sales during the year was 21.6 million. Sales were uniform at a margin of 25%. 7. The partnership was converted into limited liability company, ABC Limited, on 1st July 2021, with the partners becoming the new directors of the company. The new firm was listed on the Securities Exchange, but not for purpose of raising additional capital. The cost incurred in listing were 100,000 shillings. 8. The sales of expenses accrued evenly throughout the year unless otherwise stated. Required: 1. A schedule showing separately the profit or loss for the partnership and the company for the year ended 31st December 2021. 2. Tax payable or refundable by ABC Limited from the profit or loss computed in B above. 3. A schedule showing the distribution of profits among the partners.
Thank you so much. When you look on this question that you are being provided with it here, it is very different from what we have already done. How is it different? It does not have a reported profit. So what am I supposed to be doing in this scenario? Now, when the question does not have a reported profit, so you can be able to calculate the taxable profit then, because already you know the format of doing your income statement. So if it does not have, then there is no any problem. Sisemi Mwalimu told me that I have to be starting with the profit, the reported profit all the time. So in this case, just come back here, you write your title the way I've done on my case, right? Just write your title the way I have done it. Then let us start by looking for our sales, which are not provided in the question. So sales. The sales are not given. What the examiner has given you there under the note number, let me check that note. Note number 6. We have been told that the cost of sales for the year was 21,600. Sales were uniform at a margin of 35%. Now, in this case, nikuja hapa, as per the accounting terms, I know very well when I'm being given margin of nimepewa 25%, it relates to sales. Na hizi sales sijapewa, but what I had been given, examiner has given me the cost of sales. So I know very well I can convert my margin to, right, markup. Right? So in this case, because I have 25 over 100, I know very well, I normally take the numerator, I subtract from the denominator, I get my markup. This turns to 25 over 75. 25 over 75. So in this case, remember, I just want to get my my gross profits, right? Because that is the thing that if I have it, it will be assisting me, right? The markup will be assisting me to get the gross profit of mine. So in this case, right, once I get my gross profit, I will be in a position to get my sales. So how am I going to be getting it? I say, to get my gross profit, I just need to take 25 over 75 times the cost of sales, which I'm given 21,600. How much is my gross profit? How much is my gross profit? So in this case, it is very simple. I say 25 divided by 75 times 21,600. I'm going to be getting 7,200. So here we'll be able to say, once I take my sales, I subtract my cost of sales, I normally get the gross profits. I get my gross profits. So I don't have sales, but I have the cost of sales of 21,600 plus the gross profit of 7,200. Sorry, is equals to the 7,200, sorry. So to get my sales, I just need to take my cost of sales on the other side. So sales zangu zitakuwa ngapi? So my sales will be equal to 7,200 plus 21,600. So how much it is? This turn to 28,800. 28,800. Now, when I come to my my question here, I know the first 6 months, this was a partnership, right? And for the other 6 months, this was a limited liability company. So I have to be carrying out my analysis concurrently, right? So that is what I'm going to be doing. Remember now, I know my sales are 28,800. 28,800. So what am I supposed to be doing here? It will be very simple. Because already our sale is 28,800 for the whole year. And I'm dealing with my analysis is for the 6 months. See, I just take this, I divide by 2. Getting the sales for the 6 months to be 14,400. And for the other 6 months, it will be 14,400. From there, let us less our cost of sales. Our cost of sales, I can see it was 21,600. Once we divide by 2, we get 10,800. And also here will be 10,800. What will be our gross profits? What will be our gross profits? I just take 14,400 minus my answer. This one will be 3,600. 3,600. Right? After you finish doing that, less allowable expenses. Allowable expenses. Ninajua sana, as per the financial statements, kama mungekuwa na other income like the discount received, ningezieka hapa after the gross profits. Sivyo? Now let us look on from the additional information provided, that information provided by the examiner. What are some of the allowable expense do we have? And I will be able to shift my gears to number 3, additional information. We have been told that the cost incurred during the year were as follows. A big given salaries and wages to staff, right? It will be salaries and wages to staff. So salaries and wages to staff will be how much? Examiner may pay for the whole year to be 1083. Once I divide by 2, here will be 541.5. And also here will be 541.5. Now, from the salaries and wages to staff, we also have another allowable expense like electricity and telephone. Electricity and telephone examiner provided you with 389.4. Once you divide by 2, we are going to be getting 194.7. 194.7, right? Next one will be repairs and maintenance. Repairs and maintenance will be how much? Once I look on the question, we are being given 294.4. Once I divide by 2, here will be 147.2. Here will be 147.2, right? The next one, we are going to be looking on the depreciation and impairment. We know very well that is a disallowable expense. Then we go to the general, we are talking about the general insurance. When I look on the general insurance, we are being given how much? The total value will be 471,000. Divide by 2. Getting to that 5.5. 235.5. 235.5. Then we have debenture interest. Debenture interest inahusiana na nini? Debenture interest inahusiana na limited liability company. Hiyo pesa yote tu, you just put them there. So the debenture interest, were even the examiner told paid by ABC Limited, amount to 150.36. That is, it means it is not going to be affecting the partners. Now we have the director's fees. Director's fees amounts to how much? The director's fees to Mepewa. The director relates to the limited liability company. You just take 1015 for 40 minus, we have been told that for the partners was 507 720. Then it means also it is equal. Hapo unaniwekea 507.72, right? When you look on the other areas, we have been told there is legal expenses affecting whether partners, legal expenses. So our legal expense amount to how much? We have been told the legal expense is 510.24 divided by 2, getting 255.12, 255.12. After the legal expenses, we have been told what? We have the medical contribution for partners and directors. So the medical contributions, right, they are allowable. The medical contributions, you know very well they are applicable to the directors. So when I say my partners are partner, it is disallowable, but for the other side will be allowable. So I just take 651.84 divided by 2, getting 325.92, 325.92. Then we go to the motor drawings. No, we are discussing about rent and rates. Rent and rates. So in this case, when I look on the rent and rates, we are being given 315.96 divided by 2. Here is 157. 157.98. The other one also will be 157.98. Then we go to motor vehicle running expenses.
Excuse me.
Yes.
For medical, we've divided by 2.
Yes.
Okay, thanks.
Medical divided by 2, but does not apply to the partnership. For partnership, it is allowable, but for the limited liability, it is an allowable expense. That is why umeona hapa nimeweka dash, but hawa nikawaekea yao.
Okay.
Now, motor vehicle running expense amounts to 500.76. You divide just by 2, getting to 50.38. 250.38. 250.38. Then we have printing and stationery. Printing and stationery. Printing and stationery. How much are we getting there? We have been told that for printing is 0.52. You divide by 2, getting 16.26. The other one will be 16.26. Now, when I look on the additional information number 4, I've been told that the following assets were purchased during the year. I just give them capital allowances, and we have only 2. We have furnitures and fittings. Furnitures and fittings, we know they qualify at the rate of 10%. Then we multiply by the cost. The cost of furnitures, we are being given 19,192, which translates to 19.2. So nachukua to 19.2, I divide by 2. This one gets 9.6. This one gets 9.6. Now, after there, we also have pickup. Pickup, 25% of 2160. 2160, yes. 0.25 times 2160, getting 540. 540 divided by 2, here we have 270, and also here we have 270. Then when you look on the additional information, also number 5, you have been during the month, the total salary is disallowable. Number 6, we have already worked on it. Number 7 later. Then number 8, we have been told the sales and expenses will be able to accrue throughout the year, nothing else. So let me get my summations here. Right? So 541.5 plus 194.7 plus 147.2 plus 235.5 plus 255.12, right? Plus 157.98 plus 250, right? 0.38, plus 16.26 plus 9.6 plus 270. We are getting 2078.27, right? So here we are going to be getting the taxable income. So on the side of the partnership, I'll be able to take that 600 minus my answer, getting 1521.73. Now let us go on the side of the limited liability company. 541.5 plus 194.7 plus 147.2. 147.2 plus 235.5 plus 150.36. 150.36 plus 507.72 plus 255.12 plus 325.92 plus 157.98 plus 250.38 plus 16.26 plus 9.6 plus 270. I'm getting 3062, right? It should be 3062 or 36 something. Let me check. There is only one cost which I think I have not included here. In note number 7, where we have been told the partnership was converted into limited liability company, ABC Limited, on 1st July 2021, with the partners becoming the new directors of the company. So the new firm was listed on the Securities Exchange, but not for the purpose of raising additional capital. The cost of listing is an allowable expense. So hapa nakuja tunasema listing cost. It is affecting the liability, the limited liability company only. So the total that we are supposed to be getting here should be 3162.24. What is the total taxable income there? So that 600 minus 3162.24, I'm getting 437.76. So wacha kwanza tumalizane na kampuni. So you pay tax liability, it will be very easy. Just come straight away and you say the tax liability, it should be 30%. 30% of 437.76. So how much is this? Times 0.3, getting 131.328. 131.328. That is the tax liability part. Now, from there, we are going to be looking on part 3, where we are being told to analyze the issues of the partners, the partners allocation schedule. So let me just work on it up here, because I just want to analyze it further so that you can be able to understand, right? Just want to analyze it a bit. Now, when I go up there, because I just want to get a certain information, we are being told that Amu and Beba have carried out a business for the several years under AB partnership. But we have also been told on 1st April 2021, they introduced a new partner, Chanda, who was to contribute 1.2 million. So in Amanisha, there was 3 months, right? Kulikuwa miezi 3 months wakiwa wawili. Na then kulikuwa 3 months wakiwa watatu. Sindio? So we are discussing about Ali Amua and Beba. So hapa nakuja tu niandike A, B, and then itakuwa na total yao hapo. And then itakuwa na ABC. Then itakuwa na total yao hapo. So that you can be able to understand very well. You just need to carry out that analysis. Walikuwa wawili 3 months. 1st April kuwakuja mtu mwingine. For the next 3 months, because the partnership will cease after 6 months, we'll introduce Chanda, who came in on 1st April 2021. So we said here, there are some of the things which normally are normally posted here. We talked about salaries to partners. We also talked about interest on capital. We have bonus. We have commission. We have talked about interest on drawings. We have said we are going to be having share, profit and loss sharing. That is how I'm supposed to be working on my allocation schedule. Now, in this case, I know very well that I've been told in note number 5, during the month of the partnership, the total salaries for the partners were 507,720. The salaries were to be apportioned according to their period each partner served in the partnership business. So 507 is for the full 6 months. Under your analysis here, we are analyzing 3 months, 3 months. So si kwanza tujue the total ya 3 months hapa na the total ya the other 3 months. So I just need to take 507,720. 507,720 I divide by 2. Ndio nijue, sorry, 507,720 I divide by 2. Hapa najua total yake hapa ni 253,860. Haya, hapa wakiwa wawili total pia ni 253,860. Sindio? Sasa ndio nijue kila mmoja amepata ngapi. Siwache niangalie before we administered a new partner how they were sharing the profit and losses. Nikiangalia mahali swali imeanzia, nimeambiwa vizuri, Amu and Beba have carried a business for the last several years under the trade name AB partnership. They share profit and losses equally. So also the salaries were share equally. So nitachukua 253,860 divided by 2. Huyu atapata 126,930. Na huyu pia atapata 126,930. Right? But wakati wali administer huyu pia Chanda, naona in note number 1 nimeambiwa Amu and Beba capital accounts reflect credit balances of 1.2 million. So also the time, in additional information too, wanasema on 1st April 2021, they introduced a partner called Chanda, right? As each share of capital, they agreed on this day to share profit and losses in the ratio of the capital. Ukiangalia capital yao kila mtu contribute 1,200 is to 1,200 is to 1,200. Hii ni 111. So it's just like taking this 253,860, you just divide by 3. Huyu atapata 84,620, 84,620. Nafikiri hapo tumeelewana up to that point. Rose, iko sawa?
Yes, iko sawa.
Good. Let us look on the interest on capital now. Interest on capital, which is already in your additional informations, right? So the interest on capital, we are being told they are where? Let me check. Can you be able to see the interest on capital? How much is the interest on capital? That is number one. Number two, we are being given, we are being given where? Can you see the interest on capital? I have been told they share profits and losses equally, with capital contributed earning interest at the rate of 10% per annum. So nikichukua 10% times, right? 10% divide by 2, because already the 10% is for the whole year. What about for the 6 months? You're going to be getting 5%. So if I take 5% times 1.2, right? This one is going to be getting 60,000. Also, this one is going to be getting 60,000. Right? Is it okay? No, it is not. 60,000 is for the whole year, for the whole 6 months. So in this case, it means for the 3 months, what have I done, by the way? Let me show you here. I have just said, because already I can see the 10% of the capital for each member may contribute 1,200. This one translates to 120. Ukidivide by 2, ndio tujue for the 6 months huyu mtu akona ngapi, hapo utapata 60,000. Sio? This is for the whole 6 months. But nataka kudetermine for the 3 months. Sio? We want to determine for the 3 months. So 3 months itakuwa ngapi? Also, remember these guys are 2 here. For the 3 months, kila mtu atapata 30. So inamaanisha total here will be 60,000. Sio? So hapa itakuwa 230 because they share equally. Hapa itakuwa 30,000. Sio? This is for only 3 months. On the other 60, because kila mtu anapata 60 for the who completed the period of 6 months. So nikuja for the other 3 months, najua huyu atapata 30,000. Right? Huyu atapata 30,000, but huyu wa mwisho atapata ngapi? Huyu wa mwisho atapata ngapi? So huyu wa mwisho, remember now, we are talking about 60. But huyu alishi only, is it for 3 months? Unaelewana mpaka hapo? 10% of 1,200 comes to this 120. It should be totaling 30, 60. Namoli, saidia mwalimu. How much for the last one?
Sorry? I don't know that one.
Sorry?
I don't understand that.
I have said very well. The rate which is provided here for the 10%, because we are calculating the interest on capital. The interest on capital. Let me calculate it here so that you understand it very well. So in this case, the interest we have ABC. The rate provided here is 10% for the whole year. Then kila mtu ame contribute ngapi? 1.2, right? Then huyu amekaa kwa biashara for 6/12. 6/12. Na huyu ni 3/12. Ni sawa? So the only way you can be able to get for each, that is what you are going to be getting. Remember, this is for the only 6 months. So hapo ukakuja hapa ya kwanza ukapata 60. Ya pili ukapata 60. Then ya tatu, right? Ya tatu umepata ngapi? 30. 30. Tuko pamoja mpaka hapo? So hii ya 60, remember, analysis yako, the 60 ni for the 6 months for A. But analysis yako ni 3. So si unamgawia 30 hapa, ile 30 ingine anapata on the other side after the admission. Hii 30 ingine iko hapa because already the total interest on capital anapaswa kupata ni 60. Hii 30 yake ingine hapa, unamwekea ile ingine hapa, right? Then huyu wa tatu anapata 30. Ni kweli? Anapata 30,000 for the 3 months. For the 3 months. So this one translates to 90,000. So if you had, kama ungekuwa umefanya ukiwa umeconsolidate yote, huyu angekuwa na 60, huyu 60, right? Then huyu wa mwisho angekuwa na 30. Na mwalimu, you understand?
Yes.
Good. Now let us go to the nothing else. I can see now what we are supposed to be focusing on, because all of this is not applicable. Acha tu nizifute azitusaidii saa hizi. Zikiwa kwa mtihani, I have shown you where you're supposed to be putting them. Let us look on the profit stock loss sharing. Right? The profit stock loss sharing. Already the profit that we are discussing about, it is this one. So in this case, hiyo tutakuja kubalance later. Ndio kwanza tuiput namna hii. That we put in namna hiyo. So in this case, we look on the adjusted business income. Adjusted business income yenye tulipata ni 1521.73. Ukidivide by 2, right? Ukidivide by 2. By the way, wacha ni multiply 2 na 100. It means we are dealing with 1521,730. I divide by 2 because we are looking on the two equal periods. So once I take 152,1730, I divide by 2. Hapo utaweka 760. 865. And also here is going to be having 760, 865. So wewe unabalancisha tu, unakuja tu unabalancisha. Tunataka kila mtu apate share yake. Unabalancisha namna hiyo. So in this case, to balance so that we can be able to understand what they are going to be sharing, I just need to take 76865, I subtract the 2, right? Ndio nipate the balance. Because nikiadi ni adi napaswa kupata 760. So it will be 760, 865 minus 60,000 minus 253, 860. Hapa napata 447,005. And you know very well the two were sharing equally. They were sharing the profits and losses equally. So I divide this by 2, getting 223 here. 223,503. Let me put it like that. And then the other one will be 223,502. Siniuliza mbona nimeweka 2, ndio ukiadi na hii 223, it should be 223, sorry. 223,502. Ndio ukichukua uadi kwa hii utapata hii without any rounding off errors. Let us go on the other side. 760, right? 865, 760, 865 minus 90,000 minus 253,860, and you'll be able to find that what the members are sharing is 417,005. 417,005, and then you divide it by 3. Huyu atapata 139,002, 139,002, right? Then you atapata 139,001. Ndio ukiadd zina total to this figure. Ndio ukiadd the total your figure because of the rounding off errors. So at the end of the day now, you are going to be calculating huyu alipata ngapi for the 3 months, ule mwingine alipata ngapi for the 3 months. So in this case, let us do our summations, right? Let us do our summations. So in this case, the first one will be 126,930 plus 30,000 plus 223,503. 503. The first one I'm getting 380, 433, 380, 433. When you go on the other side, I'm just going to be having 84,620 plus 30,000 plus 139,002. This one I'm getting 253, 622, 253, 622. Then the last one will be 84,620 plus 30,000 plus 139,001. This also will be, oh, they were the same, 253, 621. 621. Any question now? Any question? Rose, I want a question from you.
No question.
But if I can give one, you'll be able to do, right?
Yes.
Good. I just want to do a small question here. Then I give you 2 assignments. Just want to do only 2 questions, or 1 question. Then I will be able to give you 2 assignments. There is a question they brought on November 2015. November 2015 there. So let us check on that question. November 2015, there is a question there. So if you have your past paper, you can be able to look on November 2015, question 5B. November 2015, question 5B. November 2015, question 5B, so that I can give you 2 quick assignments. Question 5 is going to be reading for us now. Someone to read, please.
I'll read. Lima Limited is a company incorporated in your country. The company controls 80% of the share capital of Shamba Limited, which is also incorporated in your country. The following is a statement of comprehensive income of Lima Limited for the year ended 31st December 2014. Gross profit 59,220, less depreciation 4872, legal expenses 508, loan interest 819, electricity 378, salaries and wages 9387, telephone 357, patent royalties paid 756, travel expenses 785, other income, patent royalties received 2772, loan interest received 193, dividend received from Shamba Limited 5628, net income 49,951. Additional information. The loan interest paid included the following: interest of 285,000 relating to a loan acquired to purchase office equipment. Number 2, interest of 258,000 relating to a loan used to acquire shares of Shamba Limited. Number 2, salaries and wages include passages of 1.008 million paid to a director who relocated to another country. Travel expenses include 155,000 paid to a new employee hired from a foreign country. The loan interest received relates to a loan issued to an employee of the company to purchase a residential house. Number 5, not included in other income was rent received of 1.638 million from one lease, gross of a loss of 397,000 made on another lease. Number 6, an operating loss of 189,000 had been carried forward for the previous 8 years. This loss was included in the salaries and wages expense as at 31st December 2014. 7, royalties of 145,000 were due for receipt as at 31st December 2014, but had not been recorded in the books. 8, legal expenses included 176,000 paid on disposal of some property and equipment. 48,000 incurred on debt collection. 78,000 incurred on defending the company against a claim of breach of contract. 9, patent royalties received were from Shamba Limited, while those paid were to a Ugandan company. 10, capital allowances for the year ended. Capital allowances for the year ended 31st December 2014 were agreed with the Commissioner at 1.932 million. Required a statement of adjusted taxable profit or loss for the year ended 31st December 2014.
So I know this is very simple for us. So let me just do it very quickly. We are just going to be starting with the reported profit, and then we do our adjustments. In this case, I can see we start with additional information. 1, we have been told that the loan interest paid include the following: the interest of 285 relating to a loan acquired to purchase office equipment. It does not relate with the business. That is a capital thing. Disallowable expense. The interest of 258,000 relating to a loan used to acquire shares. That is an investment center, should be working on that, and it is a disallowable expense, does not relate with the business. So in this case, my question is going to be starting there on the additions of the interest on loans. So I say the interest on loan, one is for Shamba, where they are going to be buying shares. The other one was for the office equipment. The office equipment. For the Shamba, we have been told the Shamba is having how much? 258. For the other one, we have been told it amounts to 285. When you go to the other information number 2, salaries and wages include passages of 1.08 million paid to a director who relocated to another country. We said the passages are good and they are okay, provided that that person is just coming to serve the employer only. It is an allowable expense, passages. Number 3, we have been told the travel expense include 155,000 paid to a newly employee hired from the foreign company or foreign country. That is allowable expense, no problem. That is we talked about taking the guy out and bringing him back. I have forgotten. There is a name there. I normally use. I'll be able to remember as we move on. Number 4, we have been told the loan interest received relate to a loan issued to an employee of the company to purchase a residential house. The loan interest received relates. So in that case, you can also see the interest on loan. We are going to be, it is a disallowable expenses. Now, when I look on note number 5, we have been told not included in other income was rent received of 1638,000 from one lease, gross of 397. We are going to be looking on those things when we are doing other aspects of the question on the other side, on the aspect of the other incomes. Now, yes.
The loan interest received, it's an income. They are receiving from what they had given an employee. It's an income.
But do you know that the business of this company is not to give loans?
Yes.
So that is an untaxable. It does not relate with the business.
Okay.
Now, even when you look on your organization, when we are advancing loans to employees, you don't factor that when you are the interest when you are agree na director. You don't come and say in the computation of the of your income statement that the interest received from Daniel is going to be used as part of our income with the business. No, that is a non-taxable income. It does not relate to the business. Now, let us look on note number 6, where we are being told an operating loss of 189,000 has been carried forward for the previous 8 years. This loss was included in salaries and wages expense as at that 1 December 2014. What is the new act talking about the operating losses? What is it talking on the operating losses carried forward? Amounting to, sorry?
Losses can be utilized annuity or something. They don't expire.
Very good. The period does not expire. The period does not expire, but you can see they included it under the salaries and wages. There before, it was supposed to be carried forward for only 6 years. 6 years. Now, note number 7, the royalties of 145,000 were due to the receipt at 31 December 2014, but had not been recorded in the books. Now, note number 8, we are talking about the legal expenses. We are being told that the legal expenses included 176,000 paid on disposal of some property and equipment. So in this case, is it allowable or disallowable? Legal expenses, right? We are discussing about the disposal of property and equipment, disallowable expense. Property and equipment amounting to how much? 176. The other one I can see the legal expense relating to what? 48,000 in kind of debt collection allowable, but we have 78,000 in kind of defending the company against a claim of breach of contract. So in this case, I can say company defense for breach of contract. Tulisemaje na moli? Company's defense against breach of contract. Tulisemaje?
If unsuccessful, we disallow. If successful, we allow.
Yes, mimi nakuja tu hapa nasema successfully. Naeka hapo dash. Right, thank you. Now let us go to number 9, where we have been told the patent royalties received were from Shamba. Those ones we are going to be dealing with them later. Now let us go to, because the capital allowances we know is an allowable expense, tutadeny huko chini later. Tuangalie hapa kwa less expenses in the income statement. Kuna kitu inaitwa depreciation. So depreciations amount to how much? 4872, disallowable expense. But I can see also we have the loan interest, allowable, electricity, salaries, telephone, patent royalties, right? Patent royalties paid, travel expenses, all that is allowable expense. Now, let us look on lessing, less. We talked about allowable expenses, right? And when we discuss about the allowable expenses, we are going to be starting with the capital. Capital allowances, which were agreed with the commissioner, were able to amount to, I can see 1932,000. Then I can see that there are some of the incomes which we were able to see they were received and included in our computation of these incomes, net profit, sorry. So we start with the patent royalties received. How much was it? patent royalties received. Patent royalties received, tumeambiwa ni ngapi? So the patent royalties received is 2772. The patent royalties received, tumepewa ngapi? 2772. Then also we have loan interest received. Hizi vitu zote tunafanya tu hapa ndio upate marks. The loan interest received amounts to 183. Right? Then the other one we are being told dividends received from Shamba, right? Dividend received from Shamba. So we are going to be looking at on how we are supposed to be treating them. Dividends received from Shamba. The dividend received from Shamba amounts to 5628. Good. Now in this case, we are going to be doing that deduction there. Then we need to add later. Then we shall shift to other incomes. So, other incomes. So when we look on the other incomes, mimi nitaanza na rental income nilisikia mahali. Rental income, I can do some assumption and I say they are residential. They are residential. Naeka two brackets na nieke dash. Na muli why have I done that? Semi rental income yangu ni residential. Sawa
For
sawa.
residential, the withholding tax is filed on, I think, at 10%.
What is the threshold?
I think 258 to 15 million.
15 million, right? The threshold now is 15 million. They shifted it from 10 million per annum to 15 million. So in this case, when I look on the rental income provided, that is the information which I will be able to provide later. Because already tutaangalia the rental income on its own. Now, in this case, we are saying that the rental income provided in this case, the rental income, which I was able to see in the question was amounting to how much? The rental income in the question. The rent, in note number 5, we have been told the rent not included in other income was the rent received of 1 million. Sasa sisi tunajua, residential are normally taxed if the threshold meets 50, if the threshold is equivalent to 15 million, right? But if they are below the 15 million, they are exempted from taxation, right? Now, what about the commercial houses? They are taxed at the rate of 10%, at the rate of 10%. Now, in this case, that is where we are putting the threshold to differentiate between the residential and commercial. So if the rental income it is below 15 million per year, then it is not subjected for taxation. Now, let us look on the other thing which we are doing here. There is a royalties, which I have seen it being talked about, royalties. Royalties, because there is some of the notes which I will be able also to share with you to read much about the royalties. They have the withholding tax at the rate of 5%, you know very well is not final. So the one which we were given in the income statement walitupea 2772. Then tunaambiwa kuna zingine zilipeanwa. The royalties of 145. Tunaambiwa 145 hawaku include, so you can include now. So it will be 2772 plus 145. We are getting 2917, 2117. Then from there, we have another income. We are discussing about it called dividends. Right? The dividends which I can see here, they were from Shamba Limited, a company which is a subsidiary to Lima Limited. So in this case, where we are controlling more than 12.5%, we say that those dividends are exempted from taxation. They are not subjected for further taxation. That is what we have said there before. So hapa nikuja kuangalia the other incomes, zitakuwa 2917. So wacha nifanye summation ya allowable expense, 1932 plus 2772 plus 193 plus 5628. 10,525. Right? These we are going to be subtracted. Now, only there is one thing that I just want to clarify here. E operational loss, by the way, we are supposed to be deleting it. Because in our current exam, hautaiweka. As per those days, yes, tungeweka because already it was supposed to be a disallowable expense because the period was 6 years. Na hii tumeambiwa wame out for 8 years. So in our case, because in the next exam wakati utaona hii, itakuwa allowable expense because it is a business loss, but it is going to be carried forward indefinitely. Sinio kweli? So it should be an allowable expense as per today's terms or the Finance Act plus 285 plus 176 plus 4872. This comes to 5591. Inamaanisha leo ukienda kufanya mtihani upate the business loss which is being carried out for 10, 15, utaambia tu examiner ni allowable expense. So hautakuwa unaiconsider kama disallowable. There before we used to have a threshold of only 6 years. So hiyo tuachane nayo. So 49,951 plus 55,91 minus 10,525 plus 29,17. We are getting a taxable income. We are getting a taxable income, right? Of how much? We are discussing about 47,934. 47,934. Now let's shift your gears to look on the tax liability, right? Let us go and do tax liabilities. This will be very easy. It will be 30% of 47,934. So it will be 0.3 times my answer. It will be 14,380.2. Then we are going to be lessing the withholding relief. Remember, nimekuambia royalties, the withholding tax at the rate of 5% is not final. So hapa nakuja na less withholding tax relief. Withholding, right? Tax. So this one will be for royalties. It will be 5% of 2917. 2917, right? 2917 times 0.05. I'm getting 145. 145.85. So the tax payable is how much? So it will be 14,380.2 minus answer. Getting 14,234.35. 234.35. Any question? Any question? Namuli, are we good?
Yes.
Rose, are you okay?
Yes, I'm okay.
No, you are okay now. So let me give an assignment. We start with, msikane hizi assignment mnakuja kunipea Saturday na Muli. One will be December 2021. December 2021, question 4B. The other one will be, let me look at it here. Right. The other one will be May 2017, question 3B. May 2017, question 3B. Right. Then we have November 2015, question 3. November 2015, question 3. I need this question be done. Sawa. Na mahali unakwama, right? Reach out. Reach out. I will be able to assist. Just reach out so that I can be able to assist. So the next time we are going to be meeting, because this is done, we are going to be doing, right? We are going to be doing a very sensitive area called capital allowances. Capital allowances. That is our next stage now. Next stage, we do capital allowances, we complete with them. Then remember, the first three topics are going to be used throughout your syllabus. That is why I say they are very important. So let me stop at that point. I'm waiting to see those assignments coming in. I will be able to upload the video for you to be able to listen to it and do your assignments. Thank you. So let me stop at that point.
Thank you.
Okay, bye-bye.